Most ICT traders lose even after all their confirmations. The sweep happens. Structure looks clean, entry feels perfect, and then price still goes against them. Not because the setup was wrong, but because the market wasn't done yet. Institutions don't move price just to take stops. They move it to finish business. And if you enter before that business is complete, you get trapped. Getting stopped out even after what feels like a perfect setup is something almost every trader experiences. You take a trade believing everything is aligned. The liquidity sweep looks clean, the confirmation feels strong, and the area seems ideal for entries. You enter with full confidence, and then price hits your stop loss. A few minutes later, price moves exactly in the direction you originally expected. When this happens repeatedly, it becomes frustrating and confusing. At first, you start questioning the setup. Then you start questioning the strategy. Eventually, you start questioning yourself. Many traders begin to believe that the market is specifically targeting them, that price is moving against them intentionally, or that market makers are hunting their stops. This mindset is one of the biggest mistakes traders make. The reality is much simpler and much harsher. The market does not care about you, your trades, or your money. You are not important enough for the market to target personally. The market operates based on liquidity, efficiency, and order flow. If you are getting stopped out and then price moves in your direction, it does not mean the setup was perfect or that the market was unfair. It simply means there was still unfinished business left in the market. One of the most important truths you must accept as a trader is this: you can never be completely right in the market. There is no such thing as perfection in trading. No one has cracked the market code, and no one ever will. The moment you think you have figured everything out, the market finds a way to humble you. That is the nature of these markets. They are dynamic, adaptive, and constantly changing. Losses are not a sign that you are failing. Losing streaks are not a sign that you are doing everything wrong. They are a natural part of the path toward profitability. The biggest mistake traders make is becoming emotionally attached to being right. Every loss feels personal, and every stop loss feels like an attack. This emotional reaction leads to demotivation, overtrading, revenge trading, and eventually blowing accounts. You must remove this mindset completely. You need to be mentally prepared to accept losses without emotional reaction. There will be losing streaks even when you follow your rules perfectly. This does not mean you abandon discipline. It means you understand that trading is a probability game, not a certainty game. I will cover psychological preparation in more depth in other videos, but for now, it is important to understand this foundation. Now let us focus on the real reason behind getting stopped out before price moves in your favor. The issue is not that the market is wrong. The issue is that there was still liquidity left to be taken beyond your stop loss. The market had not finished its job yet. Even if your direction was correct, your timing or your stop placement was not aligned with where liquidity truly rested. In most cases, when price stops you out and then reverses, it is because the market needed to access liquidity beyond your entry level. Your stop loss was sitting in an area where liquidity naturally existed, and price had a reason to move there before continuing. This is not manipulation against you. This is simply how the market functions. Understanding this concept is what separates emotional traders from structured traders. Once you realize that losses are information, not punishment, you stop taking them personally. You begin analyzing where liquidity actually was, not where you wanted it to be. And that is when your execution, patience, and consistency start improving. In this video, I'm going to show you how to identify these situations and how to reduce the number of times you get stopped out before the real move begins. You cannot eliminate losses completely, but you can avoid many unnecessary ones by understanding how liquidity truly works. This is where real improvement in trading begins. In this case, let me show you exactly why we got stopped out even though everything looked correct. We had a proper sell-side liquidity sweep, multiple confirmations, a clear change in state of delivery, an order block, an inverse fair value gap, a market structure shift, and even a fair value gap. Almost everything was aligned, so the question is, why did price still stop us out? To understand this, we need to look at the higher time frame first. When we analyze the 15-minute time frame, we can see that although liquidity was sitting in the discount, it was not aligned with a strong price delivery array. There was still an unfilled order block resting in the discount that had not been mitigated yet. This already gives price a valid reason to move lower before continuing higher. Now, when we shift down to the lower time frame, the picture becomes even clearer. On the 1-minute time frame, we can see equal lows resting below our stop loss. In addition to that, there was low resistance liquidity present in the same area. All of this liquidity was sitting directly below our stop. Because of this, it was very obvious that price would move lower, take that liquidity, and only then consider continuing in the intended direction. As you can see on the chart, price does exactly that. It sweeps our stop loss, fills the unmitigated order block, cleans up the equal lows, respects each of these areas, and only after all of that business is completed does it move toward the original target. This is the key lesson you need to understand. Every time you take a trade, you must make sure that there is no remaining reason for price to move further against your position. If you are taking a long trade, there should be no significant liquidity, no unfilled order blocks, and no obvious targets resting below your entry or your stop loss. If there is still unfinished business below, price will almost always go there first. This is not the market being unfair, and it does not mean your analysis was useless. It simply means you entered too early, before the market had completed its work. Once you start identifying and removing these reasons before entering a trade, you will dramatically reduce the number of times you get stopped out right before the real move begins. Now I'm going to explain a few key things that you must always check before entering a trade. These are the conditions you need to be aware of every single time you execute. If you ignore these, you will continue getting stopped out even when the setup looks perfect. The first thing you must make sure of is that your trade is planned deep in discount, assuming you are taking a long position. A long trade should always be taken from a discounted area of the range and must be supported by a higher time frame unfilled price delivery array. If price is not deep in discount and there is no supporting price delivery array, there is a very high probability that the trade will fail. In most cases, when these two conditions are not aligned, the trade has roughly a 70% chance of not working. That is why both discount and higher time frame PD array alignment are non-negotiable. The next thing you must check is whether there is any remaining liquidity below your entry or stop loss. There should be no obvious reason for price to move further against your position. For example, if you are trading a 15-minute range and price is in discount with a valid PD array and even a sell-side liquidity sweep, that alone is not enough. You must still look below and see if there are any unfilled fair value gaps, unfilled order blocks, or any other unmitigated PD arrays. If any of these are present below your trade, you do not enter. You wait until those areas are filled. In addition to that, there are other forms of liquidity that you must be aware of. Equal lows or equal highs resting close to your stop loss are major warning signs. Low resistance liquidity zones near your stop are also a problem. If any of these are present below a long trade or above a short trade, price will most likely move toward them before going in your intended direction. Because of this, your rule should be very simple. You only enter a trade when all of this liquidity has already been tapped. There should be no unfinished business left against your position. When discount, PD array alignment, and liquidity clearance all line up, your entries become much cleaner, and the chances of getting stopped out before the real move begin drop significantly. That's it for this video. I hope this breakdown helped you better understand liquidity, entries, and why trades get stopped out, and that it improves your overall trading performance. If you found value in this video, make sure to like, share, and subscribe for more ICT concepts, market structure, and real chart breakdowns. You can also join my Discord trading community for daily discussions and learning. If you're interested in mentorship or prop firm discount offers, all the links are in the description below. Thanks for watching, and I'll see you in the next video.